which is 20,000, right? So you can also believe here as well. A 50,000 increase in sales revenue results in 20,000 increase in CM ratio, which means increase in sale multiplied by CM ratio. Answer would be net operating income. So we can go to the net operating income by passing all the format, all this format. Just find out how much above we are selling from our break-even sales, total sales, and multiply by CM ratio. That's it. Right? Any question? Subhan, Junpyo? Junpyo, you understand?
Yeah, I think so.
Good. So if you understand, let's do this example here. So I'm going to give you 5 minutes to do that. So those who are watching online, please pause the video here and try to read it and pick the right answer. So meanwhile, I am pausing the video. Okay, let's solve it together. So Coffee Clutch is an espresso stand in downtown office building. The average selling price of a cup is $1.49. So selling price is $1.49. 1.49. Sorry about my writing. Let me just erase this. So we have 1.49 is the selling price, SP. The average variable expense is 0.36. Variable cost 0.36. We know that sale minus variable cost is your CM per unit, right? So 1.49, 1.49, 1.49 minus 0.36, answer would be 1.13. So CM would be 1.13. So we want to find out CM ratio, right? CM ratio. CM ratio would be CM divided by, if CM is per unit, then sales would be per unit. Remember that one. If CM is in dollar, then sale will be in dollar. You have to compare apple to apple. If base is dollars, then numerator also would be dollars. If numerator and sales are in units, then answer would be correct. So here, now the sale is 1.49. So 1.13 divided by 1.49. So do we have 75.8%? .758. Answer would be B.
Sir, I have a question.
Yes, sure.
Then why like the average fixed expense per month is like 130? Why even?
This is average fixed expenses. On average, this is not the per unit, this is just they are mentioning, but it is a total expenses. In total, it's not that average. You can take that as a roughly fixed expenses per month are 1,300. This is not the divided by quantity. It's not like that. Because I told you in questions and in practical life, we don't use fixed cost per unit. Right? So that's why they mention fixed cost per month. And variable is fixed variable expense per cup. See that? The question mentioned fixed cost per month, not per cup. But the variable cost is variable expense per cup, right? So there is a difference. So you can just ignore this average. So we know that the CM ratio would be 75.8% or 0.758%. Don't you understand?
Yes.
Good. Let's move forward. So it means we can convert our this equation where profit is equal to CM multiplied by quantity minus fixed cost into this one. If we have a ratio, then CM ratio here. But when we are using ratio, then there is no quantity here. Instead of quantity, you write down the total sales. So there's a difference between when you are given data in terms of CM ratio, when you are given given data in terms of CM per unit, then the equations would be like that: CM ratio multiplied by sales. If CM units, so CM unit multiplied by quantity. That's the only difference. That's it. So let's verify that. So if RBC increases sales to 500 bikes, what would be the management expect profit? Here, we know that 40% of the total sales, answer would be 100,000 minus fixed cost, answer would be 20,000. Right? So we verified over this equation as well. Now, I'm opening the breakout room activity. So please take a picture. And I think we have a couple of questions. I would be posting all the pictures in our breakout room activity. And then we finally see our solutions and compare our answer as well. So I'm going to pause the video here for those who are watching online. And then we resume after the breakout room activity. Okay guys, welcome back after the breakout room activity. So let's go and check our solution. So before going there, let me read the question. So last month when Holiday Creation Incorporation sold 50,000 units, total sales were 200,000, total variable expenses were 120,000 and fixed expenses were 65,000. So you are required to calculate contribution margin ratio. Second, pay close attention to the question as well. Secondly, estimate the change in company's net operating income if you were to increase its total sales by 1,000. Right? First of all, you find out the CM ratio is 40% correctly. How you can find out the CM ratio? You find out CM. CM is total sales minus total variable cost, which is 80,000. 80,000 divided by total sales, 200,000, answer would be 40%. So if we were to increase the sale 1,000, so CM would be increased 40% of the increased sale, 400. So CM would be increased by 400. So here is the verification. So if the new sales were increases from 200,000 to 201,000, here we go. So you see variable expenses per unit, you can easily find out variable expense per unit would be given as well. So our net operating income would be increased by 400. So why to calculate all these verification when you have a simple verification trick in your hand, that is increase in sales, which is from 200,000 to 200,000, 1,000 multiplied by 0.4. Answer would be 400. Right, Subhan and Junpyo? Now you understand that?
Yes, sir.
Yes, sir.
Well done, well done, well done. Let's move forward. Now, show the effect on contribution margin of changes in variable cost, fixed cost, selling price, and volume. So up till now, what we have discussed, what if we increase the sale price? What if the sale price increase, what if the sales increased from 200,000 to 201,000? Now we are also changing variable cost. We are also changing fixed cost. We are also changing the quantity sold. Let's see that. So the variable expense ratio is the ratio of variable cost divided by sales, right? So yeah, we can also calculate it through unit wise. We can also calculate it into ratio wise. Ratio is the same. The total variable cost divided by this total variable expense divided by sales, or in unit, you can also find out variable expense divided by 500 sales. So variable expense divided by unit selling price. So let's just see that. What is the profit impact if the RBC racing bicycle can increase unit sales from 500 to 540 by increasing the monthly advertising budget 10,000? So we are playing now with fixed cost